How to manage black swan volatility. Why are we talking about black swan volatility when volatility is crashing? Tony,
Yeah, yeah.
why? Why?
Anticipation.
Anticipation.
Preparation.
When when volatility is cheap and the market's when volatility is cheap and the market's kind of record highs and volatility is on its butt, it's always the most dangerous time and always the time you should be talking about black swan market volatility. When you don't need to talk about it is when we're in the middle of something ugly happening, because then it's too late. Let's go.
Sosnoff, I've got an ARB for you. You can send Frankie for $50 a night, which I think is quite reasonable, to Baby Shark's house. He's renting out a bed at $50 a night. I think it's worth it for you to send Frankie there.
Well, your wife just texted me and she said I could send him to your house for $100 a night. And so I'm going to pay the $100 just to do that.
She's going to pay you to take me, is what she said.
No, she's just flipping you guys out.
Thanks.
$100 a night, worth it. Let's go to the next slide. Black swan events are rare, but when they do happen, market conditions can change rapidly, and traders don't always have much time to respond. That's why they're black swan events, because you don't have any time to respond. So as much as you want to think, oh man, I should just adjust this, or I'll just put a stop order in here, it doesn't work like that. Okay, it's you got to stay small to start with, and you got to be very clear of the concept of what can happen in markets. So we're going to take a look and see how long it's taken the VIX to reach a certain level of expansion historically, and is it possible to protect against black swan market volatility other than staying small? Is it, Tony?
I mean, this is a tough question to answer. I'm going to say no. I'm going to say really it's going to come down to size, but you could argue about entry with higher implied volatility, but I'm going to say no, it's all about size.
I think it's all about size too. There are some arguments throughout the industry that, that certain mental stop orders can be effective, certain adjustments can be effective. Tony and I will not argue either of those points. A mental stop of doing something regardless is probably pretty good. Doing something, making adjustments is even better. But thinking that you can protect yourself with a hard stop, we all know in periods of volatility explosion, you cannot. That's why professional firms sometimes go out of business. Back in, when was it? Was it 2000 that that one firm got blown up? The one VIX ARB firm got blown up because that was the 2000 in the pandemic, and one of the biggest firms on the floor of the SIBO that does specifically index ARB, that's better at it than anybody you've ever met, they blew up because their positions got too big. It's all about position size. It's when genius fails is when positions get too big. Anyway, Let's go to the next slide, Beth. So all I'm saying is if the best firm in the world at trading index ARB or volatility ARB can blow up, anybody can blow up. But nobody can blow up if your positions are small. That's just how it works. So the VIX, the last 10 years we're going to look at, and we're going to determine the average number of trading days it's taken for the VIX to experience an expansion from under 20 to over 30, from under 20 to over 40, and then from under 20 to over 50, which rarely happens. We're also going to measure the shortest and longest durations recorded for each expansion. The VIX expansions have taken roughly 2 to 4 weeks, or 10 to 25 days on average. But they have also occurred over a few days in the most extreme cases. So there have been a significant number, there have been significant expansions, 50 plus recorded, that have the most consistent range, 8 to 29 days, suggesting that predictable crisis, suggesting predictable crisis volatility patterns. So what we did here is we basically just charted it out for you. So you can kind of see the total number of events. The significant event in the last 10 years, I'm really surprised it happened 4 times. I agree with you. I would have sold that. The moderate events only happened 5 times. So each of those, for some reason, had a print above that. The smaller events from under 20 to over 30, which we are right now, has happened 22 times in 10 years. That means 2 times a year. That means it is not ridiculous for us right now to be having this conversation.
Yeah, I agree.
It's happened 2 times a year for the last 10 years. No, that's just averaging it, but that's how many times it's happened. So we have to respect that. Average number of days, 17 days. Shortest recorded is 1 day. And the longest recorded was, say, 42 days. Okay, so we're in that wheelhouse now, under 20 to potentially over 30. I'm not saying it's going to happen. It's just saying we're smart to talk about it. So the duration of the VIX expansions recorded have varied significantly, meaning that traders cannot necessarily expect to have ample time to respond to the volatility. And I think that's very fair. I mean, if it happens in a day, there's not much you can do. If it moderate, you go from under 20 to over 40 in 2 days. You think you can protect yourself against that?
Yeah.
Right. Now it's only happened that has, I mean, the shortest recorded is only 1 time, but still, it's just know that it's out there. That's all we care about is that it's out there.
That's what keeps pricing, the way it is. And that's what we take advantage the other 365 days a year.
The fastest expansion recorded was just 1 trading day. That was February of 2018. How crazy is that? Because you never would have guessed it was 2018. Now, the reason 2018 is interesting is because 2017 was a dead freaking year. We didn't have a 1% move all year. And that was Trump's first full year in office. So,
right, which you would have thought would be completely the opposite.
Which you would have thought would have been opposite. And then it was the second year in February that we had the crazy move. And this is after we made a new high. And this is after volatility dropped down. If you remember, January of 2018, the market made a new high and volatility had just crapped the bed. It was like 11 or 12%. I might have even gotten the 10 handle. It went, at that point in February, it went from 17 to 37. Crazy. Small expansions dominate, while moderate expansions, okay, they're obviously rare. Moderate expansions of over 40 are the fastest on average at 13 days. Small expansions have the widest range, 1 to 42 days. Most VIX expansions complete within 10 to 25 days. You saw a perfect example of that in April of this year. And then the significant expansions of over 50 have the most consistent range, 8 to 29 days, suggesting predictable crisis volatility patterns. I don't know how predictable they are, but suggesting
I don't know, because they're all one-offs. I don't think it's predictable either. We're just showing what has happened in the past, assuming that that's going to happen in the future. And that's a pretty big assumption to make.
That's all true. But the most important time to be reviewing this stuff is right now when volatility is low. And you agree with that, right?
100%.
Okay.
100%.
Let's go to the next slide. I mean, there's no riskier time for vol expansion than when it's cheap. When it's expensive, so are options, so the risk is so much less. Black swan events often catch traders off guard because they happen rapidly and unexpectedly. Of course, the same reason that, an earthquake catches everybody off guard. Traders can protect themselves from these events by keeping position sizes small and well diversified. Period. That's the key. The adjustments and the mental stops, that comes on top of this, but the real key is keeping position sizes small. I don't want to mislead anybody thinking that, hey, you know what, you can protect yourself other ways. So some of the takeaways. VIX expansions have taken roughly 2 to 4 weeks. And you saw the last time this happened was in April of this year. 10 to 25 days on average, but have also been known to take place over just a few days in extreme cases. Because there is so much variability in how the VIX has behaved, traders should not rely on having time to react to market turbulence. Tony and I, we've experienced virtually every kind of market turbulence over the years, and there's no way that either one of us One of the reasons we make so many adjustments is because we never know if we're going to have any more time to react. Like until you've actually experienced it, you don't really have the same instincts. So we make a lot of adjustments because we don't know what we're reacting to what the market's doing. We don't know what's in the future, short term. Could be very different than you think.
Because we know that fact. That is correct.
Right. Traders can protect themselves by using appropriate mental stops and keeping positions small. And mental stops just mean, hey, you know what? I got to make an adjustment here. Hey, you know what? I got to reduce the size of my position here. Hey, you know what? I got to do something here. And I kept my position small, so I'm okay.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.